Happy Friday, everybody. I'm Josh Spisman. I'm an associate professor of finance here at Loyola Marymount University in Los Angeles, and I'm with my colleague, as usual, David Offenberg, also an associate professor at LMU. And David, I see you're standing in front of Costco,
Here I
and
am.
I've been waiting to get back to do some shopping myself, and things are starting to look up in the economy. We're starting to see some positive news happening, and so I would expect that companies like Costco, where people, consumers are going to start spending more and more money, and I would think that companies such as Costco and others are going to this is going to be great news, and their stock price would shoot right up. And yet, I noticed this week
And
that
yet,
yeah, and yet here's a stock return for Costco this week, which today's March 5th, so I'm doing a Monday to Thursday just so that we don't have any live news happening, and it's down about almost 9%, about 8.8%. And so I'm wondering what is going on. Why would a company that I expect to see a lot of increased revenues going forward as the economy turns around, why would a company like this perform so poorly? So I'm hoping you could help me out.
sure. And Costco is just the anecdote, right? They
Right.
are one of thousands of companies that have been suffering this week.
That's
So
right.
let's go back to this, the basis of all of finance, the time value of money formula, which, if I remember, you said your dad read this to you at night when he was putting you to sleep when you were a kid.
That's right. Yeah. And it hasn't changed. It hasn't changed.
It hasn't changed. But what this formula says is that a dollar today is worth more than a dollar in the future. Investors use this formula to find the price of a stock because the price of the stock is supposed to be the present value of all future cash flows. So let's just pretend we've got a stock, this stock, which the blue bars here are the cash flows coming off the stock, starting at $100 a year from today and going up about 2% each year. And we'll go all the way out to 20 years down here. And then the orange bars are what happens if you put each of those cash flows into that formula. So if you discount each of those cash flows by 20%, you get the orange bar. And this is how much those cash flows are worth to the investor today. So notice in year one, the orange bar, it's pretty much the same size as the blue bar. The time hasn't done much to diminish that. But then as we go back and back and back and back all the way down here to 20, look at how tiny that is. That 20th year, that cash flow is worth almost nothing to the investor. So almost all the value of the stock is here in these first few years because we have a big discount rate, the 20%. So investors are going to front weight this. And if we do the math, we'll find that the stock at this price should be $534.03 with a 20% discount rate. But you said something about rates, right?
I did. So we've noticed, right, that the rates have actually been increasing this week. Could that help explain it?
Absolutely.
All
So
right.
let's switch the rate then. Let's switch the rate from 20% to 11%. So the orange bars here are the same. It's the same 20% we were using before. But now the green bars are what happens if we put in an 11% rate. So rates go down. And what you can see again, at the beginning here, the green bars are a little bit bigger. But look what happens by year 7, 8, 9. All of a sudden, these green bars are twice as big. And these later cash flows get much bigger, 6 times bigger by the time we're up to the year 20. And so as rates go down, these later cash flows become more valuable. And so that gives a lot of explanation for why we saw stock prices shoot up during the pandemic. People thought, how can this be happening? There's a
Right.
pandemic. Consumers are spending less. How can stock prices be going up? And look what happened to the stock price. It goes from 534 over here to over 900 over here, just because of a change in the rates.
Right. And of course, this is a little, dramatic change, right? 20% to 11%. But even a 1% change could have a big impact on these on what the future cash flows are worth today, right?
Totally true. Totally true. And the other thing that's totally distant from reality here is that this is not what happened to most companies in the pandemic. Most companies, these first year, 2, 3 years, disappeared. And so we can look at what happens there too. And what you can see, even if I take out the first 4 years of earnings for this company and just zero them out and they go away, I mean, still the stock price is higher because these later years are worth so much more. And so that's what happened in the early part of the pandemic. All these early years got zeroed out and people were valuing the later years more. But now, as rates go up, the Fed is raising rates, investor expectations of rates are going up, the stock prices have to come back down. And I think that's what we're seeing this week.
I think that makes a lot of sense. That's great. Yeah, that's awesome. Thank you so much, David.
Yeah. And with that, you can now go shopping at Costco and
That's right.
hopefully find a bargain again.
Well, let's hope so.